What does it look like when a market doesn't just dip, but gets absolutely blindsided? Because that's exactly what happened to India in 2026, and it happened fast. Three massive forces hit Indian markets at the same time, and none of them were gentle. First, foreign portfolio investors, or FPIs. Think of them as the big, loud, high-spending table at a restaurant. Just got up and walked out. All of them. In less than 4 months, they pulled 1.68 trillion rupees out of Indian equities. And in March alone, they sold stocks every single trading day, draining somewhere between 1.1 and 1.18 trillion rupees in just 1 month. When the biggest spenders leave the room, you feel it immediately. Second, crude oil lost its mind. Brent crude, the global price benchmark for oil, surged over 22%, hitting $90.1 a barrel. And at its absolute worst in March, it spiked all the way to $119.5 a barrel. Now here's why that stings India specifically. We import 85% of our oil. We don't produce nearly enough domestically. So every time global oil prices go up, India pays more, and that cost doesn't stay at the pump. It bleeds into fuel, transport, manufacturing, and yes, your grocery bill too. Third, the rupee quietly took a beating, depreciating 3.5% against the dollar, landing at 93.1 rupees per dollar. For foreign investors, that's a double loss. Their Indian stocks are falling, and when they convert their returns back into dollars, they walk away with even less than they expected. The result of all three hitting at once. The Sensex dropped 7.9%. The Nifty fell 6.8%. And BSE-listed companies collectively wiped out 10.1 trillion rupees in market capitalization. This wasn't a slow bleed. This was a storm. And it arrived all at once. So now the real question. Why were global investors running in the first place, and what was happening on the world stage that spooked them so badly? That's exactly what we're getting into next. So now that you know the scale of what's happening, the real question is, who's actually getting hurt and who's quietly cashing in? Let's start with the losers, because they're the loudest right now. FPI-dependent sectors have taken a brutal beating. Large banks, big financial stocks, the kind that foreign funds were heavily parked in, have watched the Nifty Bank Index drop 17%, with a staggering 60,655 crore rupees in outflows hitting financial stocks alone. That's not a dip. That's a wall falling on you. Then there's the import-heavy crowd. Airlines, oil marketing companies, anyone buying goods priced in dollars. They're getting squeezed from both ends simultaneously. Crude is expensive and the rupee is weak. So an airline paying for jet fuel in dollars, with crude above $90 a barrel, and the rupee sitting at 93 rupees to the dollar. Their costs have just quietly ballooned while their ticket prices struggle to keep up. Not a fun place to be. Now flip it around. Because here's where it gets interesting. Export-oriented businesses? They're actually smiling. IT services, pharma, textiles. If you earn in dollars and convert back to rupees at 93 rupees instead of 90, you just made more money without lifting a finger. That's a real margin boost, no extra work required. And domestically focused sectors like auto and FMCG are holding up surprisingly well. Their revenues don't care about global capital flows. Even DIIs and retail investors running monthly SIPs are using this moment to buy quality stocks at a discount. The buy when there's blood in the streets crowd is quietly at work right now. So your position in all of this comes down to one thing: whether your money flows in dollars or rupees. Next, let's talk about what India can actually do about any of this. So now you know the what and the why. The real question is, what do you actually do with all of this? Think of high oil prices like a fever, mild fever. Crude around $70 to $80 actually gets the blood pumping. But once it crosses $100 and stays there, the body starts struggling. And right now, that fever is forcing the RBI to keep interest rates higher for longer to stop inflation from running wild. Which means borrowing stays expensive. So if you are sitting on a business loan plan and waiting for rates to drop, don't hold your breath. That relief is not coming fast. Now here is where it gets interesting. Yes, foreign portfolio investors have pulled out over 1,68,000 crore rupees in under 4 months. That is dramatic. But the market has not collapsed, and that is not an accident. Domestic institutional investors and millions of retail SIP investors are absorbing that selling pressure every single month, like clockwork. Picture a house party where the loudest guests storm out, but the core group stays, keeps the music going, and honestly, the vibe improves. That is your Indian domestic investor right now, quietly holding the floor. On the rupee side, if it slides past 93 to 95 rupees to the dollar, the RBI will step in. So extreme currency collapse is unlikely. But if you are an importer or buying foreign software or equipment, hedge your exposure now. Do not wait for it to get worse. And for investors, lower valuations are genuinely creating entry points. Quality domestic-focused names in auto, FMCG, and healthcare are worth a serious look. The big picture takeaway? This is a stress test, not a collapse. The businesses and investors who stay calm, think long-term, and make calculated moves through this volatility. They are the ones who will look back at this period and say, that is when I got ahead. Panic is a strategy, just not a good one. Follow us for more updates like this. Thanks for watching. And don't forget to follow us on YouTube, Instagram, and X.